Hello everyone. In this video we will be discussing the ISA 265, which is communicating deficiencies in internal control to those charged with governance and management. It is auditor's responsibility to communicate appropriately to those charged with governance any deficiency or misstatement found during the audit in the financial statements or internal control. Internal control of an organization involves the management and the control environment. An auditor have to evaluate this internal control by evaluating whether an organization's policies and procedures are effectively being managed or not. So whenever an auditor plans for an audit, he is required to perform a risk assessment on its internal control as well, and also test for the appropriateness of the design of that internal control. During this process, auditor might identify the deficiencies in internal control. So ISA 265 clarifies that whenever a deficiency exists, it must be communicated to those charged with governance. A deficiency in internal control can be defined as any control that is designed, implemented, or operated in such a way that it is unable to prevent, detect, or correct the misstatements in the financial statements on a timely basis. What is the scope of ISA 260? The scope is to understand the internal control, then the purpose of considering the internal control. First of all, the auditor must have to take the understanding of the relevant internal control of an organization for the audit, and then identify the risks of material misstatements and afterwards assess those risks. The purpose of considering the internal control by the auditor is to design audit procedures that are appropriate in the circumstances. And ISA 260 does not impose any additional responsibility on the auditor. The objective of ISA 260 is to identify the deficiencies and ensure appropriate communication of any material or immaterial deficiencies to those charged with governance. What are the requirements of ISA 265? It starts with the identification of the relevant internal control and testing the internal control for any deficiency that might cause misstatements in the financial statements. Afterwards, evaluating the significant deficiencies only, leading to the communication of those significant deficiencies to those charged with governance. And that communication shall be done by the auditor to the managements at all appropriate levels. ISA 265 also signifies the contents of the written communication to those charged with governance, and also lays down all the matters to be explained in those communications. Now, what are some significant deficiencies that might occur in internal control? For that, you first have to understand the meaning of significant deficiency. Any misstatement that has occurred, or the likelihood of that misstatement could occur, the significance of a deficiency depends on whether a misstatement has occurred or the likelihood that a misstatement could occur. The potential magnitude of the misstatement the significant deficiency might be a misstatement that has occurred or the likelihood of a misstatement, or it can be a potential magnitude of that misstatement. And significant deficiency may also exist even if no misstatements are identified during the audit. Now, what are some of the factors that help us determine the significance of a deficiency? It can be the susceptibility of a related asset or liability to loss or fraud. It can be the complexity involved in the accounting estimate. When will the deficiencies be considered significant? Whenever the likelihood of deficiencies lead to material misstatements in future, or the misstatements detected by the auditor that were not prevented, not detected and corrected by the internal control, or the restatement of previously issued financial statements due to error or fraud. And it can also be evidence of management's inability to oversee the preparation of financial statements. A single deficiency may not be significant on its own, but a combination of deficiencies affecting the same account balance, the disclosure, or relevant assertion on an internal control component may increase the risk of misstatement and result in a significant deficiency. There might be legal and regulatory requirements in some jurisdictions, which requires the auditor to communicate the specific types of internal control deficiencies to those charged with governance and other parties, which can be the regulators themselves. The auditor will use his professional judgment to determine which matters should be communicated and may also consider the requirements and guidance of the ISA. Any matter required by the law may also be treated as equivalent to significant deficiencies under the ISA 260. The applicability of ISA remain The requirements of ISA 260 remains applicable even when law or regulation requires the use of specific terms or deficiencies. Written communication highlights the importance of significant deficiency, thus, any communication to those charged with governance regarding the deficiency must be in written form. ISA 260 provides the guidance when governance is also involved in management. The auditor must timely communicate the deficiencies to those charged with governance. For listed entities, communication may be required before approval of financial statements, while for other entities, communication may be issued later. Written communication forms part of the final audit file, and final audit file should normally be completed within 60 days of the auditor's report date. The level of detail depends on the professional judgment, and oral communication does not replace the written communication. The size and complexity of the entity, the nature of the significant deficiencies, defines whether the communication should be done orally or written. Governance and management may already be aware of the deficiencies. They may choose not to remedy due to cost or other reasons. An auditor must still communicate the significant deficiencies regardless of the cost considerations. Repeated communications of the unremedied deficiencies. Prior communication does not remove the need to communicate again. If not remedied, the auditor may repeat or reference prior communication. Failure to act without rational explanation may itself be a significant deficiency. For smaller entities, communication may be less structured compared to the larger entities. Now let's discuss the contents of the written communication. The auditor must explain the effects. Deficiencies may be grouped, and communications may include suggested remedial actions, the management responses, and whether implementation was verified or not. Auditor may state more extensive testing might identify more deficiencies. So, communication is intended only for governance. It may not be suitable for other purpose. Law or regulation may require the copies of written communication to be sent to regulators. Auditor may identify relevant regulatory authorities in the communication. Some significant deficiencies may call into question management's integrity or competence and involves fraud or intentional non-compliance. In such cases, it may be appropriate to communicate directly to management. ISA 240 and ISA 250 also provide guidance for fraud and non-compliance with laws and regulations. So this was all on ISA 265. So wrapping up, hope you liked the video. Thank you.